Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Nasdaq futures tumble on concerns that a cheaper AI model from Chinese startup DeepSeek could threaten US big tech. President Trump holds off hitting Colombia with sweeping tariffs after reaching a deal on the return of deported migrants. Plus, markets brace for a big week from central banks, with the Fed and ECB both set to deliver rate decisions.
In the meantime, a quick check on these markets. We are kicking off this week and this Monday with a very gloomy mood. Eurostoxx 50 futures down over 1%. The FTSE 100 right on its heels, down about 0.7%. But the real pain is concentrated over in the U.S., specifically in those Nasdaq 100 futures, down about 2.4%. We're going to dive into those details. At the same time, we have one eye on Russian sanctions, another eye on tariffs coming out of the States, and of course the volatility around the commodity space. We're going to break that down as well. Brent crude at a 77 handle, down 0.7%. The countdown to the opening trade starts right now.
Monday morning, good morning, or is it? It feels like we are firmly risk off right now. The reason for that, tech's going to be a big theme this week. We've just been talking about what's happening with DeepSeek, but also the tariff agenda absolutely front and centre. What is that going to mean for markets? Also fold in the immigration angle, and it all gets pretty interesting when it comes to risk assets, particularly over in the United States. So that's kind of the setup this morning. DeepSeek. Where did this one come from? It's been around for a while, but nobody saw it coming.
Yeah, absolutely. And Tom was just showing a chart at the end of the last hour of the new searches for DeepSeek have really taken off in the last month or so. Even though the team at Bloomberg Intelligence, have been writing about this for up to a year. So this is not a secret, this business. But the fact that it's performing so well on the Apple App Store does seem to be something that's really interested a lot of people. This, of course, a large language model could rival what we've seen from OpenAI and Meta. And so the logic goes, if they can do it really cheaply, if they can do it with chips that aren't so advanced, and if they can do it in a specific way that means that the training and the inference is done a lot more cheaply, then why do you need to spend so much money on all of the NVIDIA chips and all of that supply chain around the hyperscalers? Does that come into question? And so US futures trade down. The trouble is we don't really know a lot about DeepSeek. There are a lot of questions still out there.
Well, the barriers of entry have just collapsed, basically, haven't they? Wasn't the big point of why Apple, Microsoft, Amazon, etc., were able to have such an edge in this is because they're sitting on trillions of cash that they can then deploy into this? If you don't need those trillions of cash anymore, can anyone do this?
It does. That maybe is the takeaway. So Richard Windsor, who's going to join us a little bit later on in the day, in the morning, has got some really interesting takes on this. A, why now? Why are the Chinese announcing this now? This is interesting in as much as we're in the first week of the Trump presidency. And are they really doing this with kind of really basic chips, or have they got their hands on some hoppers and actually that's the reality of the situation?
And is it really as cheap as it would present? And we've had our own team at Bloomberg Intelligence saying, look, we have to treat these numbers, the reports of how cheap it is, with a great deal of caution. And Richard Windsor echoing that, saying, actually, what is exactly the role of the Chinese state in this, for example? Just one of the questions he raises.
Yeah, and we should mention that in the last, I think, couple of weeks as well, the PBOC has also come out and said maybe we need to start budgeting for how we invest in AI, which is something maybe sounds very eerily similar to what you're hearing out of the U.S. government as well, which takes us perfectly to the drama of the last 48 hours when it comes to the U.S. government. Tariffs on Colombia tied to the immigration policy, having a ripple effect in things like oil, coffee, cut flowers, in case you were worried about what Valentine's Day is coming. Exactly. All that getting kind of expensive. It looks like the deal has come through. We still don't know the specifics of the deal negotiated between Colombia and the United States, but it comes back to this idea that this tariff saber rattling has already started, and the Achilles heel of this strategy is the effect on inflation for everyday customers.
Yes, exactly. And this is with quite low risk for the US when it comes to Colombia, because they don't import very much from Colombia. Colombia, as you say, much more reliant on exporting things to the US in terms of the scale of its economy. But this does tell us, away from the specifics of Colombia, it tells us quite a bit about the way that Trump is prepared to use these tariffs to get what he wants. And it tells us, as you say, Kriti, about how we're going to see this reflected in markets, FX reacting, for example, and the way that he'll just announce things on social media, seemingly out of nowhere. And that's just the volatility we get used to.
So two takeaways from this from my point of view, one of which is, to your point, that Trump is prepared to use tariffs. The market has come to the end of the first week assuming that he actually, his bark is worse than his bite. That's interesting. Also, that immigration is important. And we haven't talked a lot about immigration over the last few days, but actually, if you think about it, with the Fed coming, that labour market story is going to be really important. And if the labour market tightens, that's going to ripple through the service sector into other areas of the economy. That's going to be inflationary. That is something that the Fed is going to have to pay attention to. Torsten Slocks just posted a note from Apollo saying the Bank of Canada has run simulations, and if the 25% tariffs are imposed, that's a 6% GDP, a 6% decline in Canadian GDP, which is enormous. And the impact of that will be rippled around the world as well.
And we're going into Fed week, ECB week, and all of these central bankers are going to be under pressure to comment or not comment. But that's interesting on immigration. Do we have enough information that now the Fed has to start factoring all of this into its analysis? Or does Jerome Powell still get to sort of rest behind that barrier and say, no, well, we haven't seen the policy yet, so therefore I can't factor it in?
In some ways, this week should be a non-event. We don't know enough to be able to talk at this point kind of properly about what impact this is all going to have. Clearly, Powell's going to face questions about whether or not the White House knows more about monetary policy than he does, because that's what Trump has implied this week. But I think the ECB is going to be interesting as well, and I think that'll be fascinating because that's going to be more about the macroeconomics than maybe the politics.
Let me argue the opposite here, which is that maybe this is actually a big deal this week, and that even though maybe we don't know the ins and outs of the tariff policy, but maybe that's why you take a dovish stance. If we're looking at the kind of roadmap here from March of 2019, when the first era of these kind of Trump tariffs came in the first administration, Jay Powell was quite quick to say, we need an insurance rate cut because we don't know what the ripple effect is.
We didn't have the inflation risk then. That was a completely different ball game. We were in a very low inflationary environment. And as a result of it, he could play that card because he didn't have that risk of inflation sitting here.
But how much policy do you need to see to give you that inflation risk? Is it enough to have the executive orders and the planes flying around and the headlines across news networks talking about immigrants being returned? Is that enough? Or do they need to see other, retrospective data around the number of people who have left the country and what that does to migration?
But how much of the inflationary effect is actually extra people coming into the country? Hasn't that been kind of a tailwind for the growth in the States, in Spain, in Canada, et cetera?
That's been a huge driver, you could argue, of US outperformance economically, has simply just been a demographics factor that is hard to quantify and difficult to kind of determine once you plug it into the models, kind of what exactly you are seeing. We're going to discuss all of this. There's so much to discuss this Monday morning. It is definitely risk off. How is that going to ripple through various asset classes? We are going to find out over the next couple of hours. Klaus Hessberger is going to be joining us from JPMorgan, Vice Chair of Global Strategic Investors and Financial Sponsors Coverage. We'll reduce that title a little bit when we get to it and figure out exactly what's going on there. Beata Manthi, Citi's Head of European Equity Strategy, is going to be joining us. Richard Windsor, longtime tech watcher, a little bit cynical this morning, judging by the notes I've read on what is happening with this DeepSeek model. And Kevin Daly, Goldman Sachs, co-head of CEEMEE. Economics. We've got the titles going today. There's certainly in title inflation, maybe in the reads that I've just read.
That must be a fun business card to hand out. Speaking of, we also have plenty of things going on this week. We talked a little bit about central banking palooza. We've got the Fed, we've got the ECB, we've got plenty of emerging market kind of central banks as well. Brazil, for example, is reporting this week among a slew of others, alongside tech earnings as well. So you have ASML, you have Meta, you have Microsoft, you have Apple. That'll all come up. And then in case your plate wasn't full, plenty of economic data sprinkled throughout the week. We have the German IFO business climate data coming out today. And then we end the week with some PCE data over in the States and CPI numbers coming out in Europe.
Those tech earnings will be really interesting. What can ASML add to our understanding about the types of chips that DeepSeek has access to and has been using, the effectiveness of those US blocks, supposedly, on sending that kind of technology over to China? And then in terms of the hyperscalers, we'll get Microsoft, we'll hear from Meta. How worried are they about DeepSeek? Does this question that huge investment that we've seen from those hyperscalers or not?
Meta's was out last week talking about the kind of, these are eye-watering numbers that these companies have been talking about spending. Do they need to do that? And even if DeepSeek's doing this with Hopper, do you need to spend this much money on Blackwell? Does it just slightly... Where does the pain get felt? Is it in NVIDIA or is it in the hyperscalers?
You're going to get plenty of other kind of pieces of earnings as well. We've got the oil earnings coming out this week. You've got Deutsche Bank earnings coming out this week as well. In addition to, of course, tech and central banks, perhaps those some sectors and clues on the broader economy as well.
It's quite the week we've got coming up. Let's set you up with some other news that you need to know as well this Monday morning. Talking of China, factory activity there has unexpectedly slowed. This ahead, of course, of the Lunar New Year holiday. Today's official manufacturing PMI falling to the lowest level since August. The service sector has also weakened, with the non-manufacturing gauge effectively flatlining at 50.2. Now, while factory activity does typically fall in this holiday period, economists are warning that this slowdown this month a little bit more severe than usual. Over in the Middle East, Israel and Lebanon have agreed to extend their ceasefire until February the 18th to allow Israeli troops more time to withdraw. Meanwhile, in Gaza, Israel says a dispute over civilian hostages has now been resolved with a deal to release another round of hostages Thursday. The developments have come against this backdrop, with President Trump controversially calling over the weekend on Egypt and Jordan to accept more Palestinian refugees in what could be a significant shift in US policy. The president said Saturday that this resettlement could either be temporary or longer term. Let's turn our attention to what's happening in Germany. There, the snap election just 4 weeks away, and the political temperature is certainly rising. Tens of thousands of people marching in German cities over the weekend. You can see the pictures in protests over the far-right AfD party. Meanwhile, Elon Musk, who has been a vocal supporter of the AfD, made a surprise virtual appearance at the party's campaign launch on Saturday.
I think you want more self-determination for Germany and for the countries in Europe, and less from Brussels. That's my opinion. I think there's too much bureaucracy from Brussels, too much control from sort of global elite. There should be more determination by individual countries. So I very much hope that the AfD does well, and that Alice Weidel does become chancellor. I think that would be very good for Germany.
The polls don't point in that direction. What is he having, a positive effect or a negative effect on the AfD? Significant protests over the weekend against the AfD. Does he change the equation? Does he change the numbers?
Go ahead.
No, I was going to come at it from a slightly different angle. Yeah. Yes, we've seen a lot of support on the ground for the AfD, but within the politics of Germany right now, there do seem to be lots of people raising questions about whether the firewall that keeps the AfD out of mainstream politics will sustain. We've asked the same in France about that cordon sanitaire that keeps the National Rally out of mainstream politics. And certainly Olaf Scholz raising an eyebrow at what the CDU under Friedrich Merz are doing right now, proposing some immigration legislation that looks as if it tax into AfD territory and saying you're going to be relying on AfD votes here. Is this the end of the firewall? So asking some really big questions.
So tacitly, the idea is there that by changing the policy mix, rather than dealing direct, you could rely on the AfD.
And we've kind of seen that in other geographies, haven't we? We've seen certainly centre-right politics tacking right to try and capture some of the electoral support for the right.
It just feels like a surprising policy move. And although where maybe you have a little bit more cushion on the immigration front and the kind of effect on an economic front, say, in the States and Canada, et cetera, I don't think Germany has that same cushion that the U.S. and Canada does when it comes to immigration, and maybe does need to kind of pinch a few pennies here when it comes to the cost that it may take with some of these deportation measures.
We will certainly keep an eye on this. We'll get Oliver Crook up on the programme a little bit later on to explain some of the nuance behind this German story for us. 7:13 here in London. We'll get back to some of the corporate earnings stories this morning as well. Coming up, Ryanair cuts its passenger growth target for a second time in 3 months as Boeing struggles to deliver aircraft. We will bring you some of our interview with the CFO, Neil Sorahan. Plus, we'll take a closer look at the role Elon Musk is playing ahead of Germany's federal election next month. Up next, we will be talking about fixed income. Lauren Van Biljon joins us, fixed income portfolio manager at Allspring Global Investments. What does Trump Week 1, Term 2 meant for global bond markets? What have we learned? If you have any questions, if you want to get involved in any of these guest conversations, IB plus BBTV Go is the function to use this Monday morning and every morning here on Bloomberg. This is Bloomberg.
Monday morning, good morning. 42 minutes to the equity market open here in Europe. We are firmly risk off. The tech trade is being represented quite strongly, more so in the States than here in Europe, but nevertheless we are lower, plus also the tariff narrative. Other assets, let's find out what's going on there. What's caught Kriti's eye this morning?
Well, Guy, you talked about the tariff story, and it automatically usually translates to dollar strength. That's exactly what you're seeing this morning, not even just against Colombia, for example, or Colombian assets, but all EM currencies, specifically over in China. Remember, China's been trying to get a little bit more of that trade volume with Colombia, and still you are seeing weakness in the Chinese yuan this morning. You are seeing weakness in the Mexican peso, the most liquid EM currency that we have our eye on as well, but strength perhaps in the Japanese yen. That's where that risk-off mood really shows up this morning. 155.82 on dollar yen this morning, and even a slight bid earlier in the session into the Swiss franc as well. But where you're not perhaps seeing that kind of volatility is in the bond market. I think that's really important because if you look at a roadmap from Donald Trump's first administration, you did see that show up in the bond volatility. I'm going to take you back in time, back to 2019, that first year where we had those tariff spikes. You can see how the volatility really increased and then decreased as you got trade deals with China. This is really the COVID pandemic. We're going to fast forward here to the banking crisis with Silicon Valley Bank, and then now fast forwarding here to Donald Trump's election. Note that volatility is actually coming down in the bond market, not necessarily going up. Is that a dislocation that we're going to see? Or maybe we're waiting to hear from some of the central banks around the world. We're going to get plenty of that, of course, this week as well, not just from the Federal Reserve this week, but plenty of EM banks as well. Brazil, Chile, then you have Canada, Sweden, and of course the ECB. I'm sure tariffs will be on their mind across the board, Guy.
Absolutely. But do they have enough information to be able to act at this point in a clear-sighted way? Let's try and find out what the answer to that question is. Lauren Van Bion, fixed income portfolio manager at Allspring Global Investments, sitting next to us around the table this morning. Good morning, Lauren.
Good morning.
Does the Fed have enough information to give us a directional trade this week?
I don't think it does, no. I think we saw that in the December meeting. We've seen that in statements since. But all central banks can really do right now is flag potential risks compared to current data. And really, it leaves them pretty much on hold.
So we have to wait for Donald Trump and whether or not he's serious about tariffs. Is that the story?
I believe so, yes. And in fact, we might not see any clarity there until really the second quarter, because we know that's when Trump's trade policy report is due from the deputies in Congress.
Yeah, the difficulty with that, though, Lauren, it seems, good morning, is that we will never know the full story on tariffs. The whole time that Trump is in the White House, he will have the power to impose a tariff wherever and whenever he wants to. So if the Fed is waiting for clarity on the extent of tariffs, that might never come. So, but then we do have some clarity gradually coming through on other things, executive orders around immigration, for example, which could also be inflationary. I mean, what is the process for the Fed actually dealing with some of this? Because it can't just ignore it for 4 or 5 years.
No, they can't ignore it, but they also can't preempt it, right? If it's not showing up in the current data, which we're not seeing.
So they're just destined to be behind the curve because they're going to have to wait for the data, backward-looking data, to show them what people expect will come.
And I think you're seeing this across the whole wide market, right? We all know that there's so much policy uncertainty into this year, into next year, into the year after, and it's going to be a huge driver of not just US growth, but global growth and inflation. But markets can't react to it yet, or don't know quite how to price it yet. I think that's why we're seeing this sort of really myopic, hyper-short-termism of markets currently.
Yeah, is that how would you characterise what we've seen in January? Because all the way through the early part of January, we saw, yields on the rise and people playing steepeners because they were worried about what Trump would mean for inflation. Yeah. And then we get to week one of his presidency, second time around, and actually things calmed down a little bit, didn't they? I mean, how long do we remain in that calm place?
I mean, if we think back to where we were a year ago and think about how much was being priced into interest rates, right, it was a huge dislocation compared to the actual realities. Currently, I mean, current pricing, and not just on the Fed, but out of the ECB, on the Bank of Japan, it looks about right given current information. So I think there's a lot less panic there that the market has to adjust on interest rate expectations. So that's let the market sort of, again, find some sort of equilibrium, at least for yields.
Well, the consensus going into the U.S. election was that, as Anna pointed out, that Donald Trump equals inflation. Is the fear of inflation making the bond markets complacent?
That's an interesting question, because usually we'd think about bond markets being the watchdogs on inflation. We've got a 10-year at over 4.5%. Which is not outrageous, given where, say, a 5-year forward on inflation expectations might be. But I think the market is really struggling to price the go-forward future into next year, into the end of this year. So I think it's trading right now far more on the short-term releases, right, and their inflation has been okay.
What is driving, then, the 10-year? I mean, I think it's so much of it is tied to, of course, the Fed policy, maybe as a response to the fiscal policy. But is there an argument to be made that perhaps break-evens or inflation expectations from consumers, even the amount of funds in the market, in the front, kind of money market funds, for example, the front end of the curve, is maybe driving the belly and the long end? Is that plausible?
I mean, certainly. I mean, it's been really difficult to get money market or short-term money to move further out the curve. I think that the duration is at least a kind of even risk reward has been out there for a while. We haven't actually seen the flows. So I think that belly longer, steepening still seems like the easiest trade from where we are right now. But the 10-year at 4.5, it's not super cheap. I don't think it's super expensive. It's really right in the middle of that range.
There's a rumor that there's an ECB meeting as well this week. I know the Fed's probably going to be more important.
Does it matter?
Does Europe need cheaper money right now? Is that something that Europe actually needs, or does it need stability in things like its relationship with Trump, the United States? Is there an argument that says, actually, it would be better to have a stronger currency than a weaker currency, particularly if you want to buy stuff from America? Is there a danger that the ECB cuts too hard, drives the euro lower, interest rate differentials, and actually that turns out to be something that isn't necessarily a good thing for our economic trajectory over here?
I think if you offered Europe a chance between geopolitical stability and easier money, they'd take the former. But that's not in their power to have, right? All they can control is the latter. So here come rates lower in Europe.
But you could make the argument that you could say, actually, we'll keep the currency relatively strong, then we can buy cheaper. We can buy more gas from America. We can buy more stuff from America, and it's going to cost us less, and that will solve part of our problem.
I mean, the one thing I do wonder on the euro is maybe we've already seen the worst, right? We got down to pretty much parity on the dollar.
102.
There's absolute disaster priced into the euro, and there has been for a significant period of time. There's a huge underweight the market has built up, and that's a hugely consensus position coming into this year. I mean, at Allspring, we had it on, right, a short euro. It worked beautifully in Q4. But if you see even just people stopping to sell the euro, even just taking a pause, that could rebound.
Is that the message that we got from all those PMI readings at the end of the week, which did seem to reprice expectations just a little bit for how much cutting we were going to get from the ECB? You know, maybe we won't get quite so much because there's a little bit of stability, dare we say it, creeping into the German data, for example.
That might be all the euro needs. I mean, maybe that's the big trade for this year. It's not so much about these sort of big directionalities, but it's finding positions that are very consensus and where that risk-reward or that asymmetry is creeping in.
All right. Lauren Van Beon, you've given us a lot to think about on Central Bank Palooza Week. We thank you so much. Fixed income portfolio manager over at Allspring Global Investments joining us on this Monday morning. Coming up, we're going to talk about how that rate pricing basically affects the world of private equity and the deal-making story as you start to see some of that deal glut loosen. The IPO market picking up on both sides of the Atlantic. We're going to be discussing the outlook for that alternative asset class with JPMorgan's Klaus Hessberger and really talking a little bit about the regulation story as well. Stick with us for that conversation. In the meantime, risk sentiment continuing to worsen. You are seeing Euro Stoxx 50 futures down about 1.2%. The FTSE 100 down 0.6%. Some of the pain isolated, maybe concentrated is a better word, into the German index. DAX futures down 0.9%. Stick with us. This is Bloomberg.
Welcome back, everybody. 30 minutes from the start of European equity trading. And the futures picture, let's have a look at where we are positioned for European stocks. Looking a little bit weaker this morning, down by 1.3% on Euro Stoxx 50 futures. S&P futures down 1.5% and NASDAQ futures down by 2.6%. And worth, making that point because of all the focus that we've put on the Chinese competition on the large language model front, which is certainly ramping up at pace. And we'll certainly get further coverage of that story. In terms of bond markets, we're risk off because of that Chinese tech story, also because of the tariff story around what we've seen from President Trump in the last 48 hours. and his handling of Colombia. So generally speaking, we're a bit risk off. We're seeing yields coming down a little bit just this morning. So those are the things that are dominating market thinking as we go into Monday, the 27th of January, week 2 for the Trump administration, second time around. Now, last year saw a rebound in private equity deal-making in Europe, but with the US continuing to outperform and President Trump promising more deregulation. So what does all of this mean for 2025? Here to discuss is Klaus Hessberger, Vice Chair of Global Financial Sponsors Group at JPMorgan. And he's recently been taking the temperature, the appetite from global investors for all things PE. So very nice to speak to you, Klaus. Good to have you with us. What does the outlook for private equity look like? Does it look like finally we get some of those exits that we've been promised, some of that activity, capital markets activity, delivering those exits for sponsors? What's the big theme of 2025?
No, good morning, first of all. Good, thanks to be here again. No, I'm actually very positive on private equity for 2025 because you have actually 3 areas. Number 1, as you say, we're expecting more activity on the exit side. Number 2, as we also just talked in the briefing, valuations are cheap in Europe, so there's more public to privates. And number 3, the activists, and you guys talked also about it last week, I listened to some reports, the activists have been very active, and they're actually driving all the deals, both on the public to private side, also on the carve-out side.
And there's a lot of focus on that theme in the UK, a lot of the activism and the cheapness of the assets, and private equity interested as a result. Is that a wider European theme, though?
Yes, actually, they're going, as our head of activist advisory is saying, activists are going global. They're everywhere across Europe. You see them in Germany, you see them in France, so in every situation. And probably what our team is expecting, definitely to last year, they're probably trying also to partner more with the private equity teams and the corporates to actually get deals done. While last year there were a lot of campaigns, at the end not so many assets traded. Probably one lesson learned for them, they actually want to make some deal flow also happen.
How much of that European PE bull case, though, is tied to the success or the strength of some of the fiscal policy in France and Germany, or even in the periphery as well, just given that infrastructure deals right now are the hottest deals you can make in PE?
I would say Europe is probably underselling itself a bit, because I don't know if you saw our team has just published something. Actually, number 1, you see patent growth in Europe is still pretty strong. Number 2, actually, we still have generate a large part of the GDP of the global mix. And number 3, actually, the rate environment for Europe is not so bad. So I'm actually a bit more positive than we Europeans always describe ourselves.
Does size matter in this? Do you have to be a big PE player to really execute some of these deals, given that, to your point, some of the capital markets have opened up, but maybe not to the extent that they have in the past? Do you have to basically have the cushions of the Apollos and the KKRs to succeed in this environment?
I would say private equity funds have differentiated themselves. So you see, of course, the large cap players like the Apollos, the Blackstones, the KKRs of the world who go for larger deals, go global and have multi-asset funds. But we see also quite successful activity by the mid-cap players who are sometimes more specialized. They're quite active in sectors like the tech space or software or services. And with them, where they sometimes are better than the large cap, they're much more local. So you see lots of them, French funds, German funds, Italian funds, and also in the US, in the Midwest. And they're quite active. They know the local assets. And that's why they're sometimes even more successful than the big players to convince families to sell to them than to the big guys.
Klaus, European politicians seem to have learnt a new word, and that's growth. Rachel Reeves is going to make a big speech this week. She was in Davos, you were in Davos, talking about that. Other European politicians are realising in a Trump world that actually growth is really important. If Europe can deliver a bit of growth, and the PMIs last week were pretty ugly, what does that mean for private equity in Europe? How coiled a spring could that be?
I would say you're right that the growth in Europe is less than in the US. But if you drill in, and that's what the private equity funds are doing, if they go into each of their subsectors, a lot of the assets actually are set up global. Most of the assets have actually exposure to the US, so benefit some of this growth across Europe. It's not a German company, it's not only active in Germany. So what the private equity guys are doing is they try probably to pick some of the assets which are undervalued and, of course, viewed by less growthy, sell some of the assets which are not so growing, and buy additional assets in the US or somewhere else to buy some additional growth.
Is the objective, there's a number of questions that come off that. Is the objective there, so you would partner a European asset with a US asset? Is that what you're saying? Would that mean that it would be more logical to list that asset in the United States?
Yeah, it's a valuation gap between Europe and US. At the moment, the gap is around 10 turns. If I go back 2000 when I started in banking, the gap was only 3 terms. Of course, various PE firms are trying, okay, I delist something in Europe, list it in the US. That's a trend we're seeing.
You mentioned the tech story as well. You mentioned that tech investments may be easier to make if you're a mid-cap fund or a mid-cap player at the moment. Northvolt kind of shook that thesis to its core, I want to say, when it filed for bankruptcy, when so many of the big PE players were quite positive on getting into that new technology. What's the lesson learned for the PE industry when it comes to investing with such enthusiasm of Northvolt and then maybe getting burnt?
Yeah, lesson learned is always when you have new technologies coming in, some work out, some don't work so well out. Of course, what the mid-cap guys are doing, I don't think they would, first of all, that diversifies their portfolio. And number two, where I see them much more active is in channel software, where the risks are not so big. But you have a founder who started a software company, and does he want to be part of a big PE shop, or does he want to partner with a tech specialist? You often see there's a tech specialist succeeding, they build the business, and then he goes to the big PE shops.
Let's talk about another sector, which is defense as well, which is a really popular space right now. Satellite companies and, of course, something that's getting a lot of support from governments across Europe. There's also an ESG hesitation, specifically in Europe, around that defense sector. What are you hearing from the folks you work with in terms of appetite to invest in defense right now?
We have, as you might have seen before Christmas, we sold 4 Chital for Carlyle in a very hotly contested auction to actually another private equity fund. Or in the US, we had the Standard Aero sell side, where PE competed with IPO market and then it listed. I would say the interest, as you say, given the attractive valuations, has materially increased in the sector, and that's why various of the other assets will probably be well received.
Klaus, and this is a very broad question, I appreciate, but what's the attitude within PEs, you think, for investing for the long term? And I ask this because for a long time, there might have been this allegation that PEs weren't focused enough on investing for the long term, and it was much more short-term returns focused. And then we held a conference at the end of last year here in London, and we talked to a number of people who were saying, actually, the public markets don't have the appetite to allow businesses to spend a lot on capex that's required. So either on data centers, big tech themes, or around greening infrastructure. And actually, those businesses might be better off with PE. How is thinking around investment in those companies that are operated by PE, how is that evolving?
Yeah, I know that's a great question, because if PE is not PE is not PE, because most of the funds, how they react, they raise more long-term funds. So both infra-like funds, which you mentioned before, but also funds where they can park assets longer. And they're going to use for those assets where actually you can probably operate an asset in longer and private. The other trend we're seeing is, of course, the continuation funds, where we're actively partnering with the Campbell Lutyens people, where especially on trophy assets or strong assets, which you can develop longer, LPs are happy to roll over. But number two, also, you find a lot of minority investors who want to be part of it, so they don't have to go private. They can keep them for longer. So that's a trend where we're seeing a lot of activity.
All right. JPMorgan's Klaus Hessberger, pleasure to have you on the program. And, of course, we're going to continue the private markets conversation throughout the week. I'm headed to Cannes tomorrow after the show. We're going to have broadcast live from the EPEM conference there, speaking with some of the big heavyweights we were just speaking to Klaus about, KKR, Apollo, Eurazeo, and Ardian, among others. I believe TKO will be joining me as well, really talking about not just how accessible it is for institutional investors to get in the private markets and the wealth space, but also maybe how it is for everyday investors to get involved in a very lucrative asset class at the moment.
Looking forward to all of that coverage coming up a little bit later this week from the south of France. Let's talk about Monday morning. NASDAQ futures under a little pressure this morning. Chinese startup DeepSeek raising questions on the future of US tech dominance. We're going to talk about that next. 19 minutes to go until equity trading starts here in Europe. This is Bloomberg.
We're a little over 15 minutes away from the opening trade, and risk sentiment is worsening across the board. Just take a look at the futures picture. Your stock 50 futures down about 1%. The FTSE 100 maybe not selling off to the extent as some of the other parts of the world are, down about 0.4%, but still very much a risk-off kind of day. A lot of the selling concentrated over in the DAX. You're already getting some pre-market indications where maybe some of the chip makers that are part of that index are going to feel some pressure. We're going to walk you through all of that. And, of course, NASDAQ futures over in the States taking the brunt of the pain this morning, down over 2%, almost 3% if you want to round up. This, of course, coming off concerns that an AI model from China's DeepSeek could disrupt the tech market altogether. The AI model seen as competitive with OpenAI's technology and could challenge the dominance of U.S. chip companies, including NVIDIA. Let's bring in someone who's been following the story very, very closely and, of course, writing about it in some depth. Bloomberg Intelligence senior analyst Robert Lee joins the program. Robert, at the end of the day, this is a cost story. To what extent did the DeepSeek developments awaken the world's eyes to the fact that maybe AI doesn't have to be as cost-intensive as we thought it did?
Well, no, that's exactly right. I think one of the things we've consistently said at Bloomberg Intelligence is the technical barrier to entry on the software side of the AI equation is, again, not to trivialize it, but it's certainly nowhere near as hard to develop a large language model as it is a bleeding-edge semiconductor chip, the likes of NVIDIA or TSMC. So whilst, again, it's still a difficult task, I think China has inherent strengths in software. They've got a very large base of software developers. It's home to two of the largest software companies globally, Tencent and Alibaba. And because of the US export controls being a potential roadblock for the Chinese companies, that has spurred them on to focus more on innovation and work their way around the problem. And that's exactly what DeepSeek has done. So they have developed a smaller, more nimble, more cost-efficient model, which is more adept at running on the locally supplied chips. And in performance terms, as you've seen, and more importantly, in cost terms, it's hyper-competitive. So I think this is a bit of a wake-up call to some people out there in the market. Having said that, from an Asian point of view, this company has been known about for, best part of a year or so, and we've been writing on it here in Hong Kong for a similar period.
Does make you wonder, therefore, why it's become so important right now. Interesting that it happens in the first week of the Trump administration. Robert, let's assume that they are doing what they are doing at DeepSeek with the significantly lower-end chips that is being suggested in much of the writing I'm reading this morning. What does it mean for NVIDIA? What does it mean for the competitors? What does it mean for Tencent? What does it mean for Baba? What does it mean for Microsoft, etc., the kind of companies they're going to see reporting this week?
That's a long list of what did it mean. I guess from a chip point of view, as the Chinese companies increase their domestic supply, it makes them less reliant on the likes of NVIDIA. But again, I think that's well understood and well known in the market. So that's, the news today sort of confirms that, and that's a trend we expect to continue. I think from the domestic point of view, the Tencents and Alibabas, it's a really cutthroat, hyper-competitive market here in China. The barriers to entry are low, as I've mentioned. The level of differentiation, although DeepSeek is obviously a strong technology innovator, still the differentiation between these different models in China is not that high. I would argue that the sector has some commodity-like tech characteristics. That makes it very difficult for companies to charge for these models. Their pricing power is relatively limited. What does it mean for the US companies? Well, really, there aren't many Chinese companies competing directly with the US. But again, I think it's a wake-up call to some within the US industry and the US investor base that, China is hyper-competitive here, and they are rapidly narrowing the gap on the software side and really are well placed as a global number two in terms of the software side of the AI equation. But I think from an NVIDIA point of view, ultimately, they are an effective monopoly in terms of what they do. There are very few companies outside or globally that can really touch them at the moment. So I think fundamentally, their story remains on track. But again, this is a wake-up call to people not to be complacent, and that, one thing we do know about the technology sector is that it's always, change is the only constant, I guess. So there's no room for complacency here.
Robert, thank you very much. Bloomberg Intelligence senior analyst Robert Lee with the lessons that we learn from DeepSeek. Joining us now with what the market is taking away from this story, our Markets Live editor, Mark Cudmore, joins us now. Mark, so we've heard there this sort of analyst view on what this means. And for analysts in the Asia region, certainly this company is not a surprise. It's not a new name. It's been around for quite a while, but it seems to be getting more global name recognition for sure right now over the weekend and into this trading week. And so what are you taking away? NASDAQ futures down 2.6% at time of, as I'm looking at them right now. What are you taking away from a market's perspective about this wake-up call?
I think it's really massive, and I think it's massive for two main points. It's not just about the challenge to US hegemony in the space. It's not about the disruption potential there. That's a kind of a side story. And I think Robert Lee's analysed it perfectly there and summarised kind of the sector challenges there absolutely perfectly. And that doesn't change the fact that NVIDIA still got monopoly in the space, and many of the big names do as well. The reason this is such a game changer is that A, it's about cost. It undermines the immense amount of money that's been spent on hardware by the US mega cap tech stocks. Sure, they want a dominant position, but it now looks tenuous that they're going to get a return on that investment. That was always difficult. But now, and this is the second aspect, now that this is open source, it really makes it very unlikely that they're going to be able to justify the return on investment, given that there's a much more cheaper alternative out there for the world to use. So ultimately, this is good for global growth. It is good for global productivity. It is positive for global stocks, but it deeply undermines the massive premium that we pay for US mega cap stocks, that exorbitant privilege that we've got. And therefore, I think this is the catalyst that people are looking for. Combined with it is a perfect timing of Trump really kind of putting an extra cost on US trade. I think it is the catalyst to end 15 years of US stock market exceptionalism.
That's quite a big call. Let's talk about the ripple effect that comes off that. Talk to me about the most correlated assets to that story. It's interesting, Bitcoin is down this morning. That obviously is being maybe a reflection of what we're seeing in NASDAQ futures. How far do the ripples spread and how quickly do they go?
So I think, first of all, this is about a relative performance idea. It's about undermining US exceptionalism. It's not. So it's saying that US stocks will fall further in bad times and rise less kind of in the good times going forward. But you're right. In the short term, while we're focused on US tech negativity, which may last for the week, then crypto is really suffering. Now, crypto seems to be suffering from a few aspects. One is I think there's disappointment that the Bitcoin reserve hasn't been announced, and people are wondering whether it will even be a Bitcoin reserve or some other crypto reserve. And then you've got the CEO of Coinbase coming over the weekend saying, look, there's 1 million new cryptocurrencies being created every week. And I think this kind of undermines the sector. I saw a piece out there, I've not checked it, verified it, but there's apparently 36 million tokens out there, which shows kind of the competition in the space for kind of these arbitrary lines in a data spreadsheet. So I think that overall, crypto is going through a tough period. It is not helped by the losses in US tech. There is definitely an overlapping investment sector. There's an overlapping kind of idea that US has leadership under Trump in both crypto and tech, and those ideas are being undermined. So I expect that US tech outperformance is now over, and I expect crypto's at least got a briefly tough period ahead.
Mark Cudmore there, saved by the bell, just as I was about to ask him about the impact of fresh-cut flowers from the tariffs, potential tariffs on Colombia. Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. Yet a more up-to-date analysis from him and the team. MLIV Go is the function on your Bloomberg terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we've got a bit of a mixed update from Ryanair today. The airline actually beating expectations on some of its revenue numbers with a decent gain for the quarter, but actually its profits declining around 12%, given some weakness in the fares. And they've also downgraded their passenger target for the years ahead, given those delays in production that we've seen at Boeing, one of their key suppliers. So it's going to be interesting to see which element of those takes most attention today. We can see the stock did have a bit of a drop in the last quarter of last year. That was mostly due to the weakness on fares that the company has warned of. So we'll wait to see how that opens in Dublin today. Then in terms of M&A, we've got the collapse of one of the big testing deals of the last few years, the industrial and testing firm Veritas and SGS, so they're no longer talking about a combination. Now, that was going to be around $30 billion worth of combined market cap, so it was a big deal. We've seen SGS coming off, the stock selling on those talks, whereas Veritas was the one rising. So we'll see if that reverses in the opening of trading today. Then back in the UK, we've got news on WH Smith, the company potentially looking to offload its high street retail store unit. That's got around 500 shops, so it is a big part of the business, but the company is looking to focus more on the travel business in airports and train stations. We can see if we look longer term, the stock never really recovered from the pandemic drop, given the closures that they saw around there. 10 buys on that, very much a favoured stock on the street. Then a couple of analyst ratings to bring you. Firstly, the big one, LVMH, that is upgraded at Morgan Stanley, an overweight on that one, and SocGen is an overweight on the Barclays radar as well. BAT, meanwhile, up at UBS today.
OK, lots to watch then in terms of those analyst ratings. Thank you very much, Joe. We'll keep an eye on BASF as well. They said late on Friday they expect to miss analyst expectations of full-year net income. That doesn't usually result in a stock going higher, so we'll watch that one with interest. Diageo are denying that they are looking to spin off Guinness and also one of their stake in Moët Hennessy, so we'll also watch that one, Guy. And tech, of course, in focus.
Yeah, you look over the last year, SAP's gone from 160 to 260. You think about where some of the tech fallout could come in Europe. Germany does seem to be maybe the epicenter of that story, so SAP could be interesting to watch this morning. Plus also ASML, some of these chip stocks certainly on the back of this DeepSeek story could be under pressure. That's the European picture this morning. The US picture, even more negative. Nasdaq futures down sharply. 5 minutes to the open. This is Bloomberg. Monday morning, a lot has happened over the weekend. This chart is completely irrelevant. This is the white line being Europe, the blue line being the United States. That's the Friday session. But we've got the DeepSeek news that we need to fold in. We've got the tariff story that we need to fold in. We're going into this week, it feels, with slightly different news that we ended last week. So, Kriti, what are futures telling us?
Well, it feels like the selling off and the risk sentiment from last week is continuing into today, in addition to the idea that we had, of course, the bad news coming from both the tariff story and the DeepSeek story. It's showing up like this, 1.4% decline in the stock 50 futures. A lot of that is concentrated in the German index. Remember, the chip makers are going to be a key piece. That Anna's going to walk us through that in a moment. A lot of the pain, though, over in the States, those NASDAQ 100 futures down almost 3%. We'll see if we get a little bit of maybe buying into the U.S. Open or certainly into the European Open, Anna.
Yeah, absolutely. So we'll keep an eye on the tech sector. Any read across from DeepSeek and the way that this has become much more of a globally known business over the weekend and into the weekend, of course. So we'll keep an eye on that. The tech sector in Europe, anywhere that's spending a lot of money, really, on AI infrastructure, we'll keep an eye on that. Ryanair also in focus. We had an update from that particular business. They've lowered their passenger growth target for 2026. They're citing Boeing's delivery delays once again. And we're also keeping an eye on WH Smith, this the retailer, of course. They've confirmed they're exploring the potential sale of their high street business. They get most of their profits, in fact, not from the high street business, but from the travel-related businesses, and so looking to hold on to those and perhaps to offload the high street ones. So we'll certainly keep an eye on that one, as well as all of the tech names then, Guy.
Tech and tariffs, that's the narrative this morning. That's what you want to focus on. We're about to get the European equity market open. Monday morning expected to deliver some downside. It is definitely risk off. How that kind of breaks across Europe, let's find out. It's time for the opening trade. So the FTSE 100, not much tech, as a result of which you may see some relative outperformance out of London today, which is going to be interesting to watch. So in some ways, that's not where the story is this morning. The story is going to be elsewhere. The IBEX is already down by 0.8%. The 600 is down by 0.1%. We'll get some more numbers coming through, I suspect, out of Germany, maybe a little bit out of Switzerland as well. But it's the chip story. The Dutch market is also going to be fascinating to watch. Let's see what happens with the AEX this morning. It's not on this board, but the German market is thick with names like SAP, which have had a great run recently and in some ways could be a casualty of what we're seeing in NASDAQ futures right now. So we don't have a trade there yet. The FTSE is down by 0.2%. I think you'd probably expect these other main markets in Europe maybe to be down by a little bit more, but it could take a while for them to get open. So what are we seeing below the surface, Anna? Kriti, single stocks, what's happening there?
Well, we are, of course, as you said, waiting for a lot of the German names to actually wake up and start kind of trading. So perhaps we're going to see a little bit more of a sell-off than we're getting right now. But off the get-go, I know we're focusing a lot on the tech story, and I'm seeing a lot of underperformance in the oil space as well. So you are seeing the likes of Shell, Rio Tinto, for example, among others, really taking a beating. And I almost feel like there's a little bit of a read-through here, maybe more in the early seconds of trading from maybe the tariff conversation than the tech conversation, as we're, of course, we're waiting for those trades to open up, because I'm seeing a lot of the EM-exposed companies seeing the biggest weights.
Well, we mentioned tariffs, we've mentioned tech. We haven't perhaps mentioned as much as we should have done in the last 20 minutes or so, the Chinese data, because that Chinese data was really quite weak, wasn't it, on the manufacturing side, despite all of the effort that the government had seemingly put into boosting activity towards the end of the year. That didn't deliver, and we saw disappointing news when it comes to Chinese PMIs. And so basic resources is the worst performing sector today, down by over 1%. And some of those names that are attached to the property sector, and it was construction and consumption in the services side that was not giving us a positive news story overnight from China. So lest we forget about the China data flow, that is also something that's having an impact, aside from some of the tech stories. We're still waiting for the CAC and the DAX to open, though, this morning.
No trade on SAP, no trade on Infineon. We need to see those numbers, but I think before we get a good gauge on what is really happening here. LVMH is up a little bit, so you've got an upgrade this morning from Morgan Stanley, but you've also got relatively weak China data, to Anna's point as well, which could ripple into the luxury sector too. But I think we need to wait and see what SAP does. Infineon's just opened. Infineon is down by 2.5%, now dropping 3%. So the chip sector story is beginning to manifest itself. Yeah, we're down by 3% on Infineon.
And we mentioned the chip sector. ASML still facing a volatility halt at the open, so perhaps some extra pain in that name that we're going to keep an eye on. It is a market sell-off, I think it's fair to say. Let's bring in a true expert in terms of how to navigate it. Beata Manthi, head of European equity strategy over at Citigroup, joins the program this morning. You picked a great day to join us. Happy Monday.
Good morning. What a Monday to pick, right?
Absolutely. You timed this beautifully. I mean, we're talking a lot about this theme of tech valuations. It feels like really kind of this cost-intensiveness, for lack of a better term, in the AI space has kind of been undermined, at least in theory, by this Chinese AI named DeepSeek. How much of that is a isolated tech story as opposed to maybe popping the bubble that has been tech valuations?
So popping the bubble is a big word still, but it has been part of our story, of our view towards the end of the year, when we've been arguing that this very one-way positioning into mega cap tech in the US is becoming very risky, right? And for us, the best diversifier away from it has been Europe within the rest of the world bucket, because every other region has its own problems. So, of course, if futures are right and NASDAQ will be down as it suggests, European tech will be down as well, right?
Yep.
But for me, more than geopolitical risks in the near future, it's all about earnings now and earnings delivery. All eyes will be on this tech results, especially in the US. The market is priced for perfection, right? It needs to deliver perfection.
There's some really big numbers at the bottom. Can I just flag, just in terms of some of the numbers I'm looking at on the screen at the moment, Siemens Energy is down. I just need to check whether that's an ex-dividend story or what is going on there, because Siemens Energy is down really hard. But names like Schneider are also down really hard as well. Like Schneider, which is a data center story, you could argue. We heard from the company. That stock's down by 6-7% at the moment on the screen that I'm watching. ASMI is down by 6-7% as well.
ASML's now open and down 8%.
Schneider's down by 5.5%. These are quite big numbers. So in some ways, Europe is immune to the tech. In theory, doesn't have that tech story, but in reality, actually, some of the heavy lifting recently has been done by European tech.
Yeah, I mean, we'll build on that, because we're talking about the valuation story. Hasn't that valuation story in tech been mostly the U.S.? Why are you seeing these numbers that Guy pointed out?
These are all very correlated trades, right? But you could argue over medium term, not very short term today, when you have a knee-jerk reaction for this first very liquid trades that are opening today, that the fact that European tech has done pretty badly last year gives it more opportunity over medium term, right? So you don't have these crazy valuation pressures I would have out of the US. But it's not cheap, because it has re-rated
What's the beta on Europe to US tech? If US tech falls out of bed, you get a big drop. What is the read across to Europe?
Define fall out of bed.
Okay,
right?
so you go down by 5% on US tech.
Yeah.
Do you go down by 2% on Europe, or do you go down by 10% on Europe? I keep asking this question because it's really unclear at this point.
So the US, so the growth sector in the US is around 50% of the entire index.
Yeah.
In the US, it's 15. But not only talking tech, it's growth, right? So in theory, you have smaller direct impact, but it's going to be impacted, no doubt about that. The valuations can shield you a bit, but in a proper risk-off environment, Europe is going to be at risk. But probably, according to our models, it's going to be a buying opportunity. Because at the end of the day, it is about the global growth prospects, right?
Mark Cudmore was postulating earlier that this could be the end of US exceptionalism. What does the end of US exceptionalism look like?
So for us, from the equity market perspective, last 2 years have been all about mega cap tech. Why? And all the gains out of S&P have been driven by this very few number of stocks. Why? Because growth was scarce, right?
Yep.
If growth is scarce, you buy it at wherever you can at any cost. Now, the view for this year, and that's to do with this global growth prospects from the economic perspective. Of course, we are coming from very low levels for many parts of the world, so you can assume some positive deltas. US growth is holding up okay for now. So our view for this year is that you could see broadening of EPS across sectors and regions. So if you see the right conditions to buy the rest of the S&P index, these have been calls from some, right? So by equally weighted versus the MAX 7. If you see the macroeconomic conditions to go for this trade, European index offers you a very similar growth profile to the rest of the S&P at substantial lower cost. You don't need to pay up for it. And the rest of S&P is very expensive as well, as expensive as MAX 7, right?
OK, so if we see that broadening trade in the US, that could play out well for European stocks.
Correct.
And so as we look at these themes that we're playing with this morning then, Beata, and they're sort of coming at us thick and fast, there's the questions around AI in the United States and whether big hyperscalers have been spending too much money to provide that service to others. Too much capex there. And then there's the theme of tariffs and what we've learned from the way that the new Trump administration will use those tariffs, as we saw with Colombia. So from a European stock perspective, what makes you more nervous of those two things? Are you more worried about the tariff story and what we're seeing from the Trump administration? Or are you more worried about US tech and how vulnerable that is? Which has more read across into Europe, do you think?
For the European index, probably tariffs if they go full on, right? Which is not our view, and from what has happened overnight, looks like it is a negotiating tool for now. And on the top of things, the European market has priced in a lot of these tariff risk in a very undifferentiated way towards the end of the year. Now, if indeed there's a huge pressure, if we come to the reporting season of MAX 7 and they come in line or disappoint, the market will be down, right? But over medium term, it's not as bad for the European market as full-on tariffs would be, as coming back with the rhetoric of punishing the rest of the world.
And what about the rate story and the way that links into your view then, Beata? Because we, of course, saw rates globally, the US in particular, but globally rising through early January and then sort of moderating a little bit, stabilising a little bit. I mean, obviously, it depends why rates rise, whether it's a growth driver or inflation fears, as to how that reads across then into stocks. Is that the base case?
Absolutely. So we've had a super strong sell-off in global bonds, really starting in September. And we've looked what happens when these sell-offs abate to equities going forward. And actually, you have a very wide range of outcomes. European equities could be up substantially with cyclicals leading, or they could be down. And the differentiated factors, the factors in common, and we looked across many factors within the macro world. Is inflation stable or falling? And is RPMIs stable or growing? So to do with the point I mentioned at the beginning, what is going to happen to global economic growth? So rates at these levels, in theory, well, there will be a problem for very leveraged parts of the market. So, for example, late last year we've downgraded utilities, right? So it's a rates call or infrastructure plays would be at risk. But overall, if rates are high because growth is strong and there are signs that inflation is in control around the world, over the medium term, not today, it could be a bullish call for continuation of the cyclical trade catch-up that we've been seeing in Europe.
Okay. That's the longer, more medium term.
Correct.
More medium term picture. Beata, great to see you. Thanks for stopping by to see us. Beata Manthi, head of European Equity Strategy, joining us from Citi. Let's talk about today, because today we're certainly seeing some fairly big moves. Take a look at what's happening with the Core 6. Anything related to the AI story is under pressure this morning. ASML is down. Look at what's happening with Schneider. All these companies that have been bid up recently around the data center story under significant pressure this morning. Remember, private equity is also in on that trade too, so let's pay attention to that too. But what you are certainly seeing is tech under significant pressure. The market is seeking safety elsewhere. Look at Nestle. It's up this morning. Some of the pharma stocks are also doing relatively well. Joe's got more details. Over to you.
So just wanted to check in on some of these other capital goods stocks, guys, because they're absolutely slammed at the moment. You mentioned there Schneider Electric. We're seeing Siemens Energy, another one you flagged, down 16%. Also seeing ABB in Switzerland, Legrand, all of these companies, anyone with exposure to the chip space getting hit on this DeepSeek news that is really taking the market by surprise at the moment. So massive drops in there, particularly Siemens Energy. Meanwhile, Ryanair gaining. Now, that was mixed. We did see a decline in their profit and also some of their passenger numbers, but the quarterly sales actually better than expected. So that does seem to be the boost on that one. Then in terms of the M&A, lots going on today. We did see that news that Veritas and SGS no longer going to be merging, and therefore we're seeing a retracement of the move. So SGS coming back up, that was the one doing the buying, therefore it had been hit. Veritas coming down at the moment. Over in the London market, WH Smith, that one was looking higher in the pre-market indications. There it is, up 6%, potentially going to be selling all of their high street retail units, according to the firm. Universal Music, meanwhile, they've got a deal with Spotify on redistribution rights and compensation for artists being taken well this morning. And then just finally on the rating change that I wanted to flag again, BAT, that was one of the best performers across Europe at the open of trading. UBS likes it due to the buyback outlook, and the stock is gaining at 4% on the London market this morning.
Joe, thank you, Joe Easton. From our equity scene with some of the read across that we're seeing from the DeepSeek story. We'll return to that shortly. Coming up, more on Ryanair as it cuts its passenger growth target once again. We'll get to that. We'll continue to focus on tech, of course, as well. This is Bloomberg. Welcome back to the opening trade. 8.16, 8.17 here in London. So just into our session here in Europe. And we are seeing a read across from the news around DeepSeek, this Chinese large language model that does seem to have taken some by surprise, many in the Chinese market, of course, following this story for a while. But it's having an impact on European tech names today. We see that evident in some of the markets we're following, and certainly on US futures. NASDAQ futures down by 3.1% right now. And so that is certainly something that wakes us up and makes us take notice. Let us get some analysis now from Richard Windsor, founder of the independent research business Radio Free Mobile. Richard, really good to get your thoughts on this. Because I suppose the question that is being raised and what we're seeing reflected in NASDAQ futures today is, does this undermine the business strategy that has seen so many big tech names in the United States spend so much money on AI infrastructure, AI technology? Is it undermined by how cheaply the Chinese seem to be doing this?
The short answer is don't know. And the reason for that is that if you cast your mind back to the Huawei SMIC thing about making super advanced chips, there was a lot of propaganda around that. The question is the main thing is it's impossible to tell at this point in time. So the good news is that DeepSeek appear to have made enough information available that someone can go off and replicate it. And if they can replicate it with that level of performance, which I would say is probably definitely real, with that level of cost that they're claiming, then we're taking a whole step forward in terms of artificial intelligence efficiency.
In terms of the compute that is required to do what this company is doing, though, is it possible with anything below Hopper. Is that something that we can look at and understand, or is it just impossible to tell?
No, the answer is it is possible. The big question is that if you trained it on the chips that we know for sure that DeepSeek has, which is an array of A100s, which is a 3 or 4 generations ago version of NVIDIA, yes, they could have done it, but it would have taken a really, really long time and cost a fortune in terms of electricity. The consensus in the market is that they had access to an array of H100s. But that's not really what's being questioned here, because everyone has access to the H100. The question is the techniques that they used, have they really been able to achieve and managed to train it to that level of performance by spending just $6 million?
But does that actually apply to maybe the roadmap or the barriers of entry for some of the U.S. tech that they are being compared to, the likes of NVIDIA or Amazon or even Microsoft, for example?
Yeah, I mean, the question here is, so if you look at it, I mean, the reason why everyone's getting nervous is that if you say that in the future demand for AI is going to be X and you need Y amount of capacity to train it, and if we assume that DeepSeek's training method is correct and it works and can be replicated, then suddenly, if demand for AI doesn't increase by 30 times, the amount of data centers that we need just dropped by 90% or more. That's what's going on right now. And the answer to that question is, I'm afraid, there's no way to tell until someone's tried to replicate exactly what DeepSeek has done.
Right. So, Richard, then the question is, to answer that then, to get to that, so we replicate it, we try and train the model and we try and do some inference and see if other people can do it for such low cost. Does that mean that... How long does that take? How long do we have to wait for that? Is that later today, or is that a week? Is that a year?
No, I think a couple of months, I would have thought. The training time for a model typically seems to be around about 30 days, seems to be that. So a month or two, I said we would get an indication one way or the other. The other way to look at it, of course, which is not quite so negative, is if the cost of AI falls by more than 90%, then you would argue that demand for it would increase even more because it comes so much cheaper and so much more economically viable to use it in so many more different industries and use cases. So that's another way to look at it.
I'm looking at anybody associated with a data center this morning under significant pressure. The stocks are down. I imagine NVIDIA is going to be down pretty sharply. Richard, walk me through kind of the concentric circles of how this ripples out from this story. Which stocks get hit hardest? How long does that last? What am I looking at here? If it's a 90% drop, how do you price that into some of these stocks?
That's a great question. The answer is, I think the way to look at this is look at how much these things have run up. Look at how much above their historical price earnings ratio or EV to sales ratios these things are on the AI hype. And that, your bottom end, your worst case scenario should be all of that froth and all of that valuation comes out and these things basically return to mean. That's your worst case scenario. I think that's unlikely to occur because if you look at artificial intelligence, there are a lot of use cases for it. Demand for it is going to continue. And even though DeepSeek may have cut the price to train massively, there's still this colossal arms race going on between China and the United States and the West, which means I don't think that even in the light of this, spending is going to come back anytime soon, simply because of this, the geopolitical environment and in terms of what's going on in terms of a race to get to advanced artificial intelligence.
Richard, always appreciate the context and your thoughts. Thank you very much indeed for joining us this morning on the back of this breaking story. Breaking, maybe that's the wrong phrase. This story seems to have been developing certainly over the last few days and weeks. Today, it's certainly having an impact. Richard Windsor, founder of Radio Free Mobile, thank you very much indeed. Ryanair stock up this morning. The stock is up by 2.2%, as you can see on the screen. The company, though, downgrading some of its forward numbers because it's simply not getting the aircraft that it wanted from Boeing due to the manufacturing constraints that company is under. CFO Neil Sorahan told us a little bit earlier about the fact that he's starting to see, and he's just been in Seattle at the Boeing facility, he's starting to see some light at the end of the tunnel.
The remaining 29 aircraft in our 210 order book will be delivered ahead of next summer, the summer of 2026, which will enable us then to catch up a lot of the growth that we've lost this year to get to 215 million passengers. So I think Boeing have turned the corner. On the production side of things, they fixed their balance sheet last year. The management team are executing on the plan. Of course, we're disappointed that we're going to be left short aircraft again this summer.
Bloomberg's aviation lead, Benedict Campbell, joining us on the story. Benny, how held back is Ryanair at the moment because they can't get the aircraft?
Well, to some degree they are still held back, but the downgrade isn't as significant as you might think. They went from 210 to 206 million, but still, that's in the space of less than 3 months, so things haven't improved. At the same time, if you look at the stock, investors are clearly looking at it sort of in a half-glass full sort of way, and they're looking at the profit numbers, the outlook. They are probably latching onto the comment that we heard just now that Boeing has turned the corner. So there is some degree of optimism built into this that they have really hit the bottom now, and it's sort of upward from here. The other thing is anyone looking for something good in the stock will latch onto this. It flatlined last year, so they have some room to recover. So this is a stock that clearly has room to move, and that's what we're seeing this morning.
Yeah, so they're really bucking the negative trend and moving higher this morning, Benny. I mean, we heard from Neil Sorahan an interesting phrase. He talked about the capacity being hugely constrained, this all to do with Boeing and its ability to supply aircraft, I guess. What does that mean, though, for Ryanair?
So it's actually good news for Ryanair in some twisted sort of way, because the demand is there. Travellers are still going on trips. They want to travel. That's very clear. The Easter bookings are looking good. The summer bookings are starting to look good, even though that's still fairly far out. But the demand is there. It's the supply side that's constrained. And it's not just Boeing and Ryanair. It's also every carrier that's using Airbus aircraft, those short-haul aircraft, the A320 on the Airbus side. That also has issues. We heard from Wizz Air continuously that they have a lot of aircraft on the ground. So all of that means that the capacity is constrained in what is still a hot market. And as a result, that means that these carriers can command higher prices because people, as I said, still want to travel. So in some slightly weird way, the fact that the demand is there helps them on the pricing side.
Certainly something we're going to be keeping a very close eye on. Bloomberg's Benedict Campbell joining us out of Berlin on those Ryanair earnings. Note that they are one of the few stocks that are higher in today's session, higher by about 2% off of that earnings report. We thank you so much. Coming up on the program, we're going to continue the conversation, maybe the other thing driving the risk sentiment in the markets. That is as Colombia U-turns after being threatened with a 25% tariff by the United States. We're going to look at the risks for other countries as well. Kevin Daly from Goldman Sachs joins us around the table. We're going to talk a little bit about the EM risk, the risk sentiment, and how well you really need to be pricing in some of this tariff story out of the Trump administration. In the meantime, European indices are pointing lower. Stick with us. This is Bloomberg. This is the opening trade. We're at 30 minutes into today's session. Seeing red across the screen, but perhaps the selling paring back just a touch. We are seeing the stock 600 down about 0.8%. The DAX is where a lot of the pain is concentrated, down about 1.2% as well, as is the French index, down about 0.9%. Maybe insulated, perhaps, is the FTSE, only down 0.3%, but certainly suffering from the risk-off narrative around the world. Part of that is going to be the tech story. The other part, maybe a little bit of the tariff conversation over the weekend. Let's dive into that aspect of the markets this morning. The U.S. is going to hold off on imposing tariffs on imported goods from Colombia after the nation agreed to accept the return of deported migrants. Now, the White House says it had announced 25% tariffs on Colombian exports after it refused to allow 2 military planes to land. Let's get some more details here and bring in Bloomberg senior editor Bill Ferries on the subject. Bill, walk us through this kind of U-turn, this 180 from the Trump administration. Walk us through the details.
Well, as you know, Donald Trump campaigned on this idea that he was going to round up undocumented migrants and send them back to the countries they came from. He had a very active first week, and this was a part of that. Apparently, he had 2 military planes loaded with Colombian migrants that was headed back towards Colombia, and the government there refused to give them the airspace or landing rights to come down. Now, if this is the kind of policy that had spread to other countries with more migrants, it really would have put a damper on, I think, one of President Trump's signature policies. So he hit back very hard, announcing 25% tariffs. He said those would go up to 50% after a week if Colombia didn't back down. And in the end, they did back down after just several hours, basically deciding to accept those migrants. We don't know if there's been any other caveats or policies with it, but President Petro's government in Colombia basically deciding to it was going to be too costly to go forward with a fight over this policy.
Yeah. Bill, the takeaway at the end of last week was that Trump tariffs were unlikely to be delivered at the kind of worst-case level that the market had feared. This weekend may be changing that a little bit. What do we now know Monday morning about the new White House reaction function around tariffs and how they're going to be used?
Well, certainly if you are a smaller economy and the U.S. president thinks he can get away if the U.S. seems to have a lot of leverage in the relationship, as it did with Colombia, tariffs are a legitimate weapon that will be invoked on very short notice if you're not in line with the Trump administration's policies. It could be a little different, we don't know, but it seems like it's a little different with larger countries, larger economies like Mexico, which also refuse to have U.S. military planes deliver migrants back. So will Mexico face tariffs as a result? We don't know. We did see some weakening in the Mexican peso as part of this, general strengthening of the dollar. But those bigger fights are the ones that I think the markets and analysts are most closely watching going forward.
Bill, thank you very much. Bloomberg's Bill Ferry's joining us there with the latest on this tariff story. Let's bring in Kevin Daly, co-head of CEEMEA Economics at Goldman Sachs. It's more complicated than emerging markets, but maybe that's a useful shorthand for us in the moment, Kevin. Thank you very much for joining us. So let's pick up where we just left off there with Bill. So what we've learnt then from this is that smaller countries are maybe going to be whipsawed by this tariff policy and have some policies forced upon them by the Trump administration. Is that what we learned from this Colombia episode?
I mean, obviously the news initially on Inauguration Day was more benign at the margin than had been anticipated. There were fears that a blanket tariff might be introduced immediately. We didn't have that, and on the back of that, our US economists have lowered the probabilities of some of the tariffs. But, you know, tariff risk clearly hasn't gone away, and it's going to be with us for a while now. We still expect as a central case quite a substantial 20 percentage point increase in effective tariffs on China. We still have a 40% chance of, 25% chance of more general tariffs across a number of economies. And it's clear that these are going to be used by bargaining tools in all manner of negotiations going forward. So this is a significant shadow that will be cast over the global economy and across EMs in particular.
Yes, and Kevin, for how long is an interesting thing to think about, isn't it? Because it seems from right now that for as long as President Trump is in the White House, this is a risk. So even if countries manage to avoid tariffs over a large period of time, tariffs could still come. You know, it's not as if he's going to tell us. He's not going to play all of his cards right now, is he?
Absolutely, and I do think it's going to be there as a risk for, I mean, perhaps, you know, for most of the next 4 years. But I think over time we will get a sense of how proactively he is going to use those. Because, you know, there are costs for the US, bear in mind, from tariffs. I mean, there are considerations that, you know, he will be factoring in the possibility of higher inflation. He's been very clear he wants lower interest rates in the US. He will have been advised that the imposition of, you know, broad-scale tariffs will raise US inflation and lower the chances of interest rate cuts going forward. So, you know, that risk, I think, will be ever present, or at least over the next 4 years. But I think over time we're likely to get a better sense of, you know, how proactive they will be used and how nervous we should be about their imposition.
There was an argument a couple years ago that in Davos was almost rescinded by the likes of the IMF and the World Bank, and that EM was where a lot of these global structural cracks were going to show up. And they've proved to be far more resilient than a lot of people expected a couple years ago. Are tariffs as impactful on that narrative, given that resilience?
No, I mean, you raise a great point, is that, you know, EMs are actually performing pretty well. at the moment. If you look at 2024, they grew in aggregate around 4%. And heading into this year, that the start of 2025, actually momentum, was pretty strong. And our, high-frequency indicators across EM suggest that EM growth was accelerating to around 5% year on year, so above potential. Growth is pretty broad-based across regions, so across Asia, across LATAM, across CEMEA, that growth is accelerating. And also the drag that they faced from very tight monetary policy in 2022, that drag is now easing. So actually left to their own devices, I think the outlook is pretty positive. It's one of the features that we have highlighted in our reports, is that there is a calm before the tariffs, is that EMs are performing relatively well. But if it wasn't for the risk of tariffs, I think we would be much more constructive on EM assets going forward. But that tariff risk is maybe slightly less than we feared it would be immediately before inauguration, but that risk is still very clearly there.
So if you're talking about maybe this insulation aspect to some of these EM currencies from the tariff story, FX markets aren't really feeling that. Like, take a look at the peso, take a look at the Brazilian real. Is the reaction function from some of these emerging markets on the fiscal front and the monetary policy front really more to address the currency? Is that the strategy they have to use?
It is. I mean, actually, it's interesting. So EM assets have been performing relatively poorly against the dollar. But if you look at against other DM currencies, so strip out the dollar, actually EM assets have performed relatively well. Now, going forward, we have a stronger dollar for longer within our forecast. We expect, because of tariff risk, because of the policies being implemented by the new U.S. administration, we think the dollar will remain strong, will actually strengthen further. So one needs to be pretty selective about EM assets going forward. But we think that against a number of other currencies, EM assets will perform relatively well. We like high-yielding EM currencies in particular. We like some of these, actually, you mentioned the peso, but we like LATAM high yielders in particular because, they are very cheap now and also they have a relatively high carry. So there are definitely pockets of value within EM, but one needs to be selective.
If US tech sells off, how does EM perform?
I mean, it's if global tech sells off and global equities sell off, then the EM won't be entirely insulated from that.
I sell Taiwan, I sell India to a certain extent, maybe. Where do you see the biggest effect? Nasdaq's down, futures are down 3%. Where does that show up in your universe?
I think you're absolutely right. So Taiwan, but I mean, I would say more generally, EM equity markets provide a degree of insulation.
So the beta is less than 1.
It is, but also EM equity markets are very cheap. I mean, EM equity markets are very underpriced relative to the US, relative to tech stocks in particular, and so it is. We think there are value. We think we quite like China, but I agree. Taiwan is the obvious. Is the obvious example which would be affected by a tech sell-off.
Beata Manthi was here from Citi a little bit earlier on, and she was making the argument that if you see a broadening out in the United States away from tech, then actually the way to play it is by buying Europe, because Europe in some ways has the characteristics of the rest of the S&P, but is on a much cheaper valuation. Does that same argument apply to EM?
Actually, I would argue if you look at the valuations of EM equities, they are remarkably similar to Europe. And yet, the growth prospects for EM, as we talked about, is that, they're growing 4%, accelerated to above 4% at the start of this year, versus Europe, struggling to grow at 1%. So, I think there is a case for diversification outside of the US, potentially into Europe, but certainly I wouldn't overlook EM equities in that regard. We like, there are a lot of EM equity markets that are particularly cheap at the moment, which, given the growth prospects they present, we think represents an opportunity.
Well, where do you stand on China then, Kevin? Because we had the PMI data out this morning. They looked pretty disappointing, actually, and some have said this is a government that was really trying to stimulate the economy at the end of last year. Others saying, no, we haven't seen that yet. They're not going to do that until we see the full policy from the Trump administration, so we wait till spring maybe for that. How do you feel about Chinese stocks?
So, I mean, Chinese stocks are the main proposition there. We like them, is the short answer. We like them because we are overweight them, because primarily on valuation. I mean, they are particularly cheap. I mean, China has...
And is that enough? Do you see, in a world with Trump in the White House, valuation is enough? You don't need a sort of calmer geopolitical backdrop?
I mean, certainly there are challenges there for China. And we think that growth will slow this year from about 5% last year to around 4.5% this year. But that's, still decent growth, and the reason why we expect growth to hold up relatively well is because we do think there will be significant further measures introduced. As you say, is that I think the Chinese authorities are holding off on those until they see they want to respond to the imposition of tariffs and not before that. So they won't show their hand until the tariffs are imposed, if they are imposed. But we think that Chinese growth will moderate this year, but won't fall dramatically. And in that environment, with given the valuation that the Chinese equity market is on, we are overweight the Chinese equities.
Kevin, great to see you. Thanks for stopping by to see us around the table this morning. Kevin Daly, co-head of CEEMEA Economics at Goldman Sachs. CEMEA. It's probably an easier way to say it, isn't it?
Thank you for putting us out of that misery. We've
just been reading it as it appears on the screen. CEMEA. Going to go with that next time. Okay, thank you very much indeed. Okay, coming up, a 10-year-old vessel-sharing deal between two of the world's largest shipping companies comes to an end this week. Are we about to see a price war? Are we heading for a shipping showdown? Probably need to fold in what is happening in the Red Sea to this discussion as well. We'll do all of that next. It's our big take today. That's next. This is Bloomberg. "46 minutes into an equity session that looks pretty ugly, certainly from a top-down point of view. There are some big names that are sharply lower. Siemens Energy is down circa 19% right now. Munster's cooling company down pretty sharply as well. So the DAX is under pressure. It's down by 1.21%. But Europe pales into insignificance compared with the drops potentially we could see on the Nasdaq this morning. It is down over 3%. You're going to see some sharp drops potentially in some AI-related companies this morning, Anna.
Yeah, absolutely. So tech story front and centre for us. We need to keep an eye on what's going on with global trade, though, of course, such a big theme under the next this Trump administration. Let's talk about a slightly different angle on that is covered in our big take story this morning. The decade-long vessel-sharing partnership between Maersk and MSC is disbanding this week. Today's big take focuses on the world's shipping giants heading for a showdown, is the way it's worded, with analysts saying it could lead to price wars and customer poaching. Let's bring in Bloomberg's Brendan Murray, who leads the global trade coverage here at Bloomberg. A really fascinating big take story, and so we'll get into some of the detail here then, Brendan. So Maersk and MSC have had this sort of relationship, this cooperation agreement in place for a while. It hasn't always been happy, so it's not much of a surprise at this point that this deal comes to an end.
Exactly. They've been rivals and partners at the same time, and now this partnership is breaking up. To put this in perspective, both of these companies, if you combine them, they are like what Saudi Arabia is to OPEC. So they're huge. They're about a third of global container capacity. And they're going to basically go on separate, they're going after the same customers, essentially, with different strategies. MSC wants to make a bunch of stops on the east-west trade routes at different ports. Maersk is, with its new ocean partner Hapag-Lloyd, is going to make fewer stops, but feed those others with what the airline industry would call puddle jumpers, transshipping at shorter distances. So the idea that through what this alliance hopes to accomplish, they call it Gemini, will be on-time arrival, something shipping has been trying to sort out for decades. About half of ships arrive on time.
And that's Maersk and Hapag-Lloyd. That's Gemini. That's
exactly.
The new one. Yeah.
Right.
Does shipping rates go up or down?
So shipping rates are going to depend in large part over the next 3 months on what happens in the Red Sea. Yep. If the Red Sea reopens to commercial vessels, then there's going to be a lot of capacity freed up. They're not going to go that long route anymore around southern Africa, and we will see shipping rates, spot rates come down quite significantly, Some folks say it could be that they could come down 20% to 50%, but they will. So it's in this environment that MSC and Maersk will be going at it for competing for market share.
Well, we're talking about the shipping rates, and the last time we see those spikes has a lot to do with, of course, the conflict in the Red Sea, and I think we were just showing some images of that as well. Since Donald Trump has come into office, he's redesignated the Houthis as the terrorist organization. That opens up a lot of military funding for that region at a time when I felt like the Red Sea was almost somewhere where the U.S. military was starting to pull out of. How does this affect the shipping environment in that area?
Well, it will hopefully have something to do with the confidence of the container shipping lines. If they see the fact that that ships can be protected, that insurance rates can come down, then we should see traffic flow through there more regularly.
Just in terms of thinking about the Red Sea, I'm sure you guys talk to shippers all the time and trying to understand what the thinking is. What's their degree of confidence? The Gaza picture obviously seems to be improving. Is that something that they have faith will continue? Kriti brings up Trump. Trump's obviously pushing pretty hard on Iran as well. The Houthis are backed by Iran. If there's a problem in Iran, does that show up with the Houthis again, maybe making shipping more difficult? It's a very complicated picture.
Exactly. Yeah. The statements that we've got from the container carriers is that they sound cautiously optimistic that they could start sailing through there again this year. But there's a big caveat there that, as you suggested, a ceasefire could end without anyone being able to predict the timing of it. If you have suddenly rerouted hundreds of ships back through there, that's going to cause huge congestion problems at destination ports. And so the shipping companies want to see 100% certainty that they're not going to get attacked by a rocket or a drone.
Great coverage, really enjoyable big take this morning. Brendan, thanks to you and the team. Bloomberg's Brendan Murray.
We'll stick with another geopolitical story we're keeping an eye on. 4 weeks before Germany's snap election, and the political temperature is rising, to say the least. Tens of thousands of people marched in German cities over the weekend in protest against the far-right AfD party. Meanwhile, Elon Musk, who has been a vocal supporter of the AfD, made a surprise virtual appearance at the party's campaign launch on Saturday. Let's get more on the story with Bloomberg's Oliver Crook joining us out of Berlin. Ollie, walk us through what Elon Musk said at the rally and how important it is to the party.
Yeah, Kriti, I mean, it sort of began with a lot of the sort of refrains that we've heard from Elon Musk over the last sort of few years, generally speaking, but also specifically towards the AfD, which is basically this idea that this sort of large government is what is sort of crushing Europe, where there's a lot of Brussels bashing, and really wanting to sort of embrace the more libertarian side of economic policy that the AfD is putting forward. And that is sort of the thing that he wanted to highlight at the beginning of the speech. Have a listen to him there.
I think you want more self-determination for Germany and for the countries in Europe, and less from Brussels. That's my opinion. I think there's too much bureaucracy from Brussels, too much control from sort of global elite. There should be more determination by individual countries. So I very much hope that the AfD does well, and that Alice Beadle is just become chancellor. I think that would be very good for Germany.
And so that's sort of the sort of standard Brussels bashing. Where things get a little bit more interesting is where he gets into sort of more of these sort of more political ideologies in there, basically saying that, multiculturalism is a sort of a failure and that basically Germans should really retain more Germanness. And of course, some of these things, when they're taken all in aggregate, some of these lines really stand out, particularly saying that basically there's frankly too much focus on past guilt, that they need to move beyond that children should not be guilty for the sins of their parents and their great-grandparents. Of course, this all sort of speaking in a veiled way about the sort of atrocities of the Second World War, coming at a time when you have had him just very recently speaking with Alice Weidel, when they go into these strange sort of digressions where they talk about Hitler basically being on the far left, not being a sort of far-right political figure, and all of these very strange things on a day where you saw, and which is why you see tens of thousands of people. They were just here over the weekend right by the Brandenburg Gate to protest what's going on here, and particularly, again, where you have Olaf Scholz in Poland right now to mark the anniversary of the liberation of Auschwitz. All of these things creating a lot of tension within the German political establishment, and frankly, a German political establishment that doesn't really know how to deal with it. As far as how it's affecting the polls, more or less the same, 30% over at the CDU and the AfD falling behind. But again, this is something that this establishment is not braced for. This is not something that German politics has had to deal with in the past.
Yes, yes, and all of those established parties have for some time operated this firewall against the far right then, Ollie, kept the AfD away from the levers of power. Now, though, the CDU, the centre-right, being accused by the left of cozying up to the AfD. What do you make of these allegations against Friedrich Merz and his immigration policies?
Yeah, so listen, there's a degree to which the AfD, even if they're not going to get into power here, and I don't think that firewall will be broken this election cycle, but it has moved the entire political discussion within Germany, even with the SPD, on the issue of immigration further to the right. What the Merz is trying to do and the CDU is trying to do is now introduce legislation that goes much harder on immigration, and he basically floated this idea that he doesn't really care who gets behind it because they're sort of agnostic. They're really focused on the policy outcome, not who sort of backs it. Of course, this got a lot of backlash from the political establishment, and he moved back and he changed some of that legislation they're trying to propose in order to make it very, very unpalatable for the AfD to get behind it, because they basically got language in there that would criticize the AfD, very, very directly. So this is something that they don't really know how to deal with, and there's a degree to which Alice Weidel has certainly been playing on this, that they don't feel that there is a choice for the right, because even if the CDU wins, it's going to have to go into coalition with the left.
Thanks, Ollie. Bloomberg's Oliver Crook there with the latest on German politics. So that's the German politics, which, of course, with the month ahead, we mustn't lose sight of. Here and now, the tech theme really writ large across these markets, Kriti.
Yeah, so let's get a quick check on those, because NASDAQ futures are really feeling the pain here, down a whopping 3% when you look at the futures picture over in the States. U.S. futures right on their heels, down about 2% as well. If you look at the chips picture, though, that's where a lot of the kind of read-through is right here in Europe. We're going to get into some of those individual names, but you can see it across the European sector there. ASML down a whopping 8%. Some names as much as 12%, we'll call it there as well. And the industrial names as well, also taking a beating.
It's fascinating. So it's the data center names that are actually, in some ways, taking some of the biggest hits here. So Siemens Energy's in the SOX 600 has taken the biggest hit, but it's names like Munters Group, which does cooling for data centers. That is where the hit is coming through this morning. It's fascinating to see Schneider down by 7.3%. Yeah. So it's not just limited to tech this morning. Yeah. It's the ripple into the rest of the economy, the kind of the data center story, and then further. That is interesting.
Really fascinating to get clarity then on just how cheaply are the Chinese able to do this inference and the training and the inference, as Richard Windsor was saying, and we will have to wait a little while until we get that clarity. And then if it is cheaper, how much demand does that create? So it feels as if this is not the end of the story, even if the direction of travel right now is downwards.
It creates a really interesting correlation, though, all of a sudden with some of the commodity costs that are inputted into it and some of the tech-based costs as well, which isn't a correlation that's really showed up yet in these markets.
Is electricity... If you do more of it, you use more electricity, but if it's cheaper to do it, then maybe use less electricity. The energy story, absolutely front and centre. EFO data about to break. We'll get some analysis on that. That's next. This is Bloomberg.